Okay, trying to navigate the world of investing, especially when you're starting out, it can feel like standing in front of a fire hose of conflicting advice, right?
Oh, absolutely. You've got experts yelling, market news changing every second. It's a lot. Information overload.
It really is. And for anyone just looking to, put their money to work, but feeling totally lost in all that noise, the big question is always just, where do you even begin?
Yeah, where is the starting line?
Exactly. So for this deep dive, we're aiming to cut through some of that complexity. We're pulling insights from some real legends in the investment world, people like John C. Bogle.
The founder of Vanguard,
Yeah.
creator of the first index fund, a giant.
Right. And we'll touch on some foundational ideas from Benjamin Graham, too.
And what's interesting is that these sources, they really champion a powerful, but actually remarkably simple, common sense approach to investing.
Simple. I like the sound of that.
Yeah, they suggest you really don't need all the complexity the industry sometimes throws at you to be successful.
So our mission here is basically to distill the most important practical principles from these, foundational texts to help you, the beginner investor, build a solid, effective foundation. What's that simple secret that seems to get buried under everything else?
Okay, let's try to unpack this.
Yeah.
Because at its heart, the message, particularly from Bogle, it's it's surprisingly straightforward, almost counterintuitive to what a lot of the industry promotes.
Okay, so tell us about Bogle. You said he's a giant figure. What was his core idea?
John Bogle was absolutely a champion for the individual investor. His whole life's work, it feels like, was driven by this passion to make sure everyday people, got a fair shake in the financial markets.
It's a fair shake.
And his core idea, keep investing simple and, crucially, low cost. He believed the traditional mutual fund industry, despite having professional managers, often failed investors.
Failed them. How? Isn't the point of a mutual fund to make you money?
That's definitely the goal, yes. But according to the source material we looked at, there's often this fundamental conflict in how many fund management companies operate.
A conflict.
Yeah, they often prioritize their own profits, driven by marketing, gathering more assets under management, sometimes over their fiduciary duty, their responsibility to the actual fund shareholders. The sources suggest, maybe unsurprisingly, that greed can get in the way.
So more focus on selling the fund than managing the money well.
Sometimes, yeah. Leads to a focus on marketing sizzle over actual investment substance, and critically, high fees.
Ah, fees. Okay, this feels central. This is where Bogle really makes his stand, isn't it? Costs matter. A lot.
They matter profoundly, especially over long term, because of something these sources call the tyranny of compounding.
The tyranny of compounding.
Yeah.
Sounds ominous.
Well, it is for your returns if costs are high. Even tiny differences in costs, when they compound year after year, decade after decade, they dramatically eat away at your potential returns.
Okay, give us a sense of how much do these costs really impact things based on what the sources show?
So let's look at some numbers presented. The sources show that typical equity mutual funds, they average around 100 basis points in expenses each year.
That's 1%, right?
Exactly 1%. Mostly going to manager payments and corporate overhead. Now, 1% might sound small.
Yeah, it doesn't seem like much in 1 year.
But compounded over time, the sources suggest it can cut your total accumulated return by 10% or more over your investing lifetime. Just that fee.
Wow. 10% or more just gone from the annual fee alone.
Yes, and that's just the stated expense ratio. You also have to consider the hidden costs, like transaction costs from frequent trading within the fund.
Hidden costs.
Yeah, the cost of buying and selling stocks.
Yeah.
Sources estimate typical trading costs are around 0.8% of the value being traded. So if a fund is constantly buying and selling what they call high turnover.
Like turning over the whole portfolio in a year.
Right, say 100% turnover, that could add another 1.6% drag annually just from trading.
Okay, so let's add that up. Maybe a 1.5% expense ratio, which isn't uncommon, plus another 1.6% in trading costs.
Now you're looking at an aggregate drag of over 3% per year.
Over 3%. So if the market itself returns, say, 10% in a good year, you've lost almost a third of that potential gain just to costs before you even see it.
Exactly. It's a huge hurdle. And this enormous drag is a key reason why Bogle proposed his big solution, indexing.
Okay, indexing. Let's unpack that. For someone totally new to this, what is indexing at its core?
The concept is actually brilliantly simple. Instead of trying to pick the winning stocks or bonds or find the genius manager who can do that consistently, An index fund just aims to own a tiny slice of all the securities in a specific market index.
Like the S&P 500.
Exactly.
Yeah.
Like owning a tiny piece of every single stock in the S&P 500, which tracks 500 of the biggest U.S. companies. Or maybe the Wilshire 5000, which is basically the entire U.S. stock market. You're not trying to beat the market.
You're trying to be the market.
Precisely. You're aiming to capture the market's return.
And why is that approach so powerful, according to these sources? Why not try to beat the market?
Well, the fundamental truth, as the sources explain it, is pretty simple math, actually. All investors, as a group, collectively own the entire market.
Right. Yeah, makes sense.
Therefore, all investors as a group cannot possibly do better than the total return of the entire market before you factor in costs.
Right, because for every active investor who beats the market, another one has to underperform it. It's a zero-sum game before costs.
Exactly. It has to balance out. And then when you subtract all the costs of all that active trading, the management fees, the marketing,
Yeah.
the average active investor or actively managed fund must mathematically lag the market's total return over time.
So the index fund just sidesteps all that effort and cost.
It does. It
Yeah.
simply aims to match the market's return before its own very small expenses.
So by not trying to be clever and just keeping costs incredibly low, you're almost guaranteed to do better than most people who are trying to be clever once you account for their costs.
That's the core argument, yes. And the evidence cited in the sources is really compelling. They show data comparing index funds to the average managed fund over a long period.
And the index funds come out ahead.
Consistently.
Hmm.
They capture far more of the market's total return for the investor. The sources give this example. Comparing returns over 15 years. An initial $10,000 investment in a low-cost index fund might grow to over $30,000.
Okay.
But the same $10,000 in a typical higher-cost managed fund.
Yeah.
Maybe it only reaches $24,000.
Wow, that's a difference of over $6,000 on just a $10 investment.
Staggering, isn't it? And that's purely down to the costs compounding over time.
That's that tyranny of compounding you mentioned, but working for you in the low-cost fund this time.
Exactly. And the sources also mention index funds tend to have lower risk, too.
Lower risk, how so?
Yeah, they cite Morningstar data showing index funds generally have significantly lower volatility. That's measured by something called standard deviation, basically, how much the investment's value bounces around. So index funds tend to jump up and down less wildly than the average active fund.
So potentially higher return after costs, lower costs during, and lower risk.
It's a powerful combination. Yeah.
Okay, I can see why so many investing greats, even famous stock pickers, have ended up endorsing indexing for most people.
Indeed. The sources quote people like Peter Lynch, Charles Schwab, even industry insiders acknowledging that the average fund just can't beat the market's total return after costs are factored in.
All right, let's talk about something specific then. ETFs, exchange-traded funds. They're super popular now, often used for indexing. What did the sources have to say about them?
Yeah, good point. The sources do address ETFs. They note that, yes, they track indexes and often have lower expense ratios than traditional actively managed mutual funds.
Okay, so far so good.
However, and this is a really crucial point in the sources we read, there's a significant critique leveled at ETFs, specifically how they work in practice for many investors.
Uh-oh. Okay, what's the caution here?
The sources highlight a couple of main issues. First, while they might be cheaper than active funds, ETF expense ratios are often still, say, 3 or 4 times higher than what the sources call classic index mutual funds, like the original Vanguard-style funds.
So still more expensive than the absolute rock-bottom cost options out there.
Right. But the second issue, and maybe the more concerning one according to the sources, is how investors actually use ETFs.
How they use them.
Yeah, because ETFs trade like stocks all day long on the exchange. They make it really easy to trade frequently. Buy this morning, sell this afternoon.
Which sounds convenient.
It sounds convenient, but it encourages behavior that often hurts returns. The source cites data showing that the actual returns investors get in ETFs have often significantly lagged the returns of the underlying ETF funds themselves.
Wait, how does that happen?
Poor timing, mostly. Chasing hot sectors, panic selling during downturns, just trading too much. All those trades incur transaction costs, potentially taxes. The source actually uses this pretty stark phrase, 3 out of 3 ain't good, to summarize the ETF picture presented. Costs that are higher than the cheapest index funds, plus this significant investor underperformance because of bad trading behavior.
So the irony is the returns investors actually pocket from ETFs often come nowhere near the returns the ETF itself generates just by tracking the index.
That's exactly the phrasing used in the source. Yeah, it highlights this key point.
So the tool itself, the ETF, is designed for low-cost indexing, but the way people tend to use the tool, trading it like a hot stock, kind of defeats the whole purpose.
Precisely. It really underscores that the strategy you employ is just as important, maybe even more important, than the specific investment vehicle you choose. Which brings us nicely to how a beginner should think about building a simple portfolio and, crucially, sticking to a strategy.
Right. Simplicity again.
Yeah.
Seems like that's the watchword here.
It absolutely is. The sources just keep hammering this home. The real secret of investing isn't some complex formula. It's sticking to simple, fundamental principles consistently over the long term.
So avoid chasing the latest trends. Avoid those costly short-term strategies.
Yeah, don't fall for the allure of unrealistic performance promises you see advertised.
Okay. So for a beginner, what's a simple starting point for actually building that portfolio? Asset allocation comes first.
Yes, thinking about asset allocation basically, how you split your money between different types of assets, primarily stocks or equity,
Yeah.
and bonds. That's fundamental. The sources suggest using your age and maybe your overall financial situation as a kind of rough rule of thumb to get started.
A rule of thumb based on age, how does that work generally?
The general principle suggested is that as you get older, you might typically reduce the percentage of your portfolio you hold in stocks and increase the percentage in bonds.
Why is that? Less risk.
Primarily, yes. The reasoning is that bonds are generally less volatile than stocks. They can help moderate the overall risk in your portfolio. The sources point to periods like the big 2007-2009 market crash.
Yeah, I remember that.
Right. Stocks plunged, but many high-quality bonds actually provided positive returns during that time. They acted as a sort of cushion for the overall portfolio.
Okay, so bonds add stability, and that becomes more important as you get closer to needing the money, like in retirement. Makes sense. It's a guideline, not a rigid rule, but a sensible place to start thinking.
Exactly, a starting point.
What about choosing which funds within those categories? Stocks, for instance.
Well, based on the sources, most individual investors, quite properly, tend to focus their equity portion on funds that invest in large U.S. companies, the so-called large cap category.
The big, well-known companies.
Right. And within that category, the sources recommend a large cap blend approach as a kind of conservative, centrist way to go. It captures the returns of these big companies, representing a mix of both growth-oriented and value-oriented stocks.
And the key thing here, regardless of the style,
is using a low-cost index fund to get that exposure. Always coming back to that cost advantage we talk about.
Got it. What about looking beyond just U.S. stocks, international?
The sources do mention international index funds as a way to add diversification. And consistent with the theme, they note these index funds also tend to have lower costs than actively managed international funds.
But maybe more risk?
They do caution about potentially higher risks and volatility in certain global markets, yeah. Particularly in emerging markets, which have seen some pretty dramatic declines at times.
Okay, so the recipe is starting to look like a simple stock-bond mix based roughly on your situation, using low-cost index funds, maybe starting with a broad U.S. large-cap blend index fund as the core.
That seems like a very reasonable interpretation of the core advice, yes.
So once you've built this simple portfolio, what's the strategy? How do you manage it over the long haul?
This is arguably the most critical part, and the simplest yet hardest advice. Stay the course.
Stay the course, meaning don't panic.
Essentially, yes. The sources really emphasize focusing on the long-term fundamentals, the underlying value of your investments, rather than getting caught up in trying to predict or time short-term market price swings.
But that sounds incredibly difficult to do in practice, especially when the news is constantly screaming about market volatility.
It is a huge psychological challenge, no doubt, but the sources are really clear on this. Constantly switching funds, trying to time the market, engaging in active trading, it almost invariably leads to disappointing below-market returns for most people who try it.
Why? Just the costs.
Costs are a big part of it. Trading costs add up. Taxes become a bigger factor if you're constantly realizing gains. But it's also just incredibly difficult to be right consistently. The sources argue that the very acceptance of indexing as a strategy is proof that active attempts to beat the market have largely failed when measured over decades. Very few managers, let alone individuals, succeed at market timing over time.
So the advice is basically Tune out the noise, ignore the short-term chatter.
Absolutely. The sources explicitly warn against taking advice from, say, the brokerage community, whose incentives are often tied to trading volume and fees, not necessarily your best outcome.
Or the TV talking heads.
Yes, those promoting constant action. They warn against chasing star managers based on recent hot performance. And interestingly, they even caution against using rating systems, like Morningstar stars, for predicting future performance.
Really? Not even Morningstar ratings.
Well, the nuance is important. The sources suggest that funds which have maintained high ratings over time, if you held them, might have done well. But they show evidence that actively trading based on those ratings, like buying funds when they hit 5 stars and selling when they drop, has historically resulted in worse returns with higher risk than just buying and holding.
Ah, okay. So the ratings might reflect past quality or performance, but they're not a reliable trading signal for the future.
Exactly. Don't use them to jump in and out. And related to that is understanding this principle of reversion to the mean.
Reversion to the mean, meaning things average out.
Pretty much. Whether it's a specific fund, a market sector, or even the market as a whole, periods of unusually high performance tend to eventually drift back towards their long-term average. And periods of poor performance tend to recover. It argues against expecting any single fund or style to stay hot forever. Don't chase yesterday's winners.
Makes sense. And we can't forget taxes, right? Especially for investments outside of retirement accounts.
Oh, definitely not. The sources call taxes the black sheep of the investment industry because fund performance is almost always reported before taxes. But you, the investor in a taxable account, have to pay taxes on dividends and any capital gains distributions.
And active funds cause more taxes?
Generally, yes. Actively managed funds with high turnover, lots of buying and selling tend to generate more taxable events. Low-cost index funds, which typically have very low turnover, tend to be much more tax efficient.
So that's another advantage. Maybe keep the less tax-efficient stuff in tax-deferred accounts like IRAs or 401ks.
That's a key strategy the sources suggest for optimizing your actual after-tax returns, which is what really matters.
This all seems to point back, in a way, to the structure of the mutual fund industry itself, sometimes working against the individual investor's best interests.
Briefly, yes, the sources do touch on that structure, where you have the fund itself, owned by shareholders, but it's managed by a separate management company. And that company's profit motive, well, it can sometimes conflict with the shareholders' interests.
How so?
They mention things like director fees, possibly correlating with higher management fees, or fund directors sometimes having very little of their own money invested in the funds they oversee, raising questions about alignment of interests.
Right, whose interests are truly being served.
Exactly. The sources encourage investors to actually read the proxy statements that funds send out, as sometimes important information, like proposed fee increases, can be kind of buried in there.
And shareholders have some power.
They do. They can vote with their feet by simply selling the fund if they're unhappy. Or they can vote against unfavorable proposals in the proxy vote. Shareholder action can sometimes curb things like excessive fee increases.
Okay, so let's try to pull this all together now. If we had to boil it down, what are the absolute core, common sense takeaways for a beginner investor from this deep dive into these sources?
All right, number one, keep investing simple. Complexity is often just a way to charge higher fees.
Okay, simple.
Number two, ruthlessly minimize costs. Expense ratios, trading costs, taxes. These are the direct enemy of your long-term returns. Every dollar saved in cost is a dollar added to your potential return.
Minimize costs. Got it.
Number three, indexing is a powerful evidence-based strategy. It aims to capture the market's full return before costs, and because of the cost advantage, it consistently outperforms most active management over the long haul.
Indexing works? Okay.
Number four, build a basic diversified portfolio based on your situation, probably stocks and bonds, maybe starting with a broad, low-cost U.S. large-cap blend index fund and adding bonds according to your age and risk tolerance. Keep it simple.
Build a simple diversified index portfolio.
Right.
And then?
And then, arguably the most important and maybe the hardest part, stay the course.
Stay the course.
Absolutely. Avoid trying to time the market. Ignore the short-term noise and the talking heads. Don't chase past performance. Limit your trading, and always be mindful of the impact of taxes. Let compounding work for you, not against you.
So this deep dive, really, it's all about equipping you, the listener, with these fundamental common sense principles pulled from timeless sources, giving you hopefully a clear, simple path to navigate the investing world effectively instead of just getting lost in all the chaos and hype.
Exactly. It's about making informed decisions based on logic and evidence, not emotion or sales pitches.
And maybe we can leave you with a final thought, something powerful from John Bogle himself to consider. He believed that while the markets might look overextended or scary at times, you should never think you know more than the market itself.
Because nobody does.
Right. Which really raises a key question for all of us, doesn't it? If even legendary experts and industry founders admit they can't consistently time the market, what does that tell us about the chances of any individual investor successfully guessing its next move?